Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Coming up on the show today, Gavin Graham, Chief Investment Officer at Spire Wealth Management, is our guest. Co-host will also dig into what's driving the disconnect between young Canadians and their income growth with Rachel Battaglia of RBC, and this year's third quarter GDP is being released this morning. We'll unpack those numbers with Jimmy Jean, Chief Economist and Strategist at Desjardins. And of course, we want to hear from you on First Call. Call us with your questions on stocks, and we'll have Gavin answer as many of them as he can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes. Our email address is firstcall@bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Identity and Culture Minister Stephen Guilbeault has resigned from cabinet over Prime Minister Mark Carney's energy deal with Alberta, specifically the pipeline agreement. Guilbeault says Carney failed to consult Indigenous communities and the pipeline would pose significant environmental risk. Guilbeault served as both Heritage and Environment Minister under former Prime Minister Justin Trudeau. He will remain in Parliament. Alberta is lifting its 2025 gross domestic product forecast. The province now expects GDP to rise by 2.1% this year, while 2026 growth is expected to moderate further to 1.8%. Alberta's budget update also signals lower borrowing needs compared to the first quarter. The province's deficit is expected to be $6.4 billion for the 25-26 fiscal year. British Columbia Premier David Eby is speaking out against the energy plan signed by Prime Minister Mark Carney and Alberta Premier Danielle Smith. Eby says the pipeline proposal included in the agreement runs the very significant risk of distracting the federal government as well as resources and pulling time away from real projects.
We need to make sure that this project doesn't become an energy vampire with all of the variables that have yet to be fulfilled. No proponent, no route, no money, no First Nation support, that it cannot draw limited federal resources, limited Indigenous governance resources, limited provincial resources away from the real projects that will employ people, provide the country with money that we desperately need, and provide investment and access to global markets to deepen our trade relationships overseas.
And all that is part of our top line story as well. Of course, Prime Minister Mark Carney unveiling that sweeping energy plan with the province of Alberta would pave the way for a possible new oil pipeline, a massive carbon capture project, and the construction of nuclear power for data centers. Let's bring in our guest co-host, Gavin Graham, Chief Investment Officer at Spire Wealth Management, to talk more about this project. I guess let's get to initial thoughts on this from a business perspective. Is there a hunger for it? And thanks for joining us. I know you're in England, so good afternoon, I guess, Gavin.
Well, thank you very much indeed, Roger. Delighted to be with you as always. And yes, this is obviously very encouraging because it's actually putting some meat on the bones of the sort of major projects that Prime Minister Carney was talking about. And the fact that after the fairly, shall one say, acrimonious relationship between his predecessor and the province of Alberta, the fact that the feds and Alberta have agreed on this, even though obviously there's a lot of details to be sort of thrashed out, is very, very encouraging because it's actually saying the federal government has said we believe it's sensible to have pipelines to the Pacific coast and to actually expand our energy markets away from the south. The other thing, of course, is that there is this major element of carbon capture. I think it's 11.8 billion, which is still in a somewhat preliminary stage as far as technology and how it's going to work in terms of being built out. Perhaps one of the more interesting things was the nuclear reactors for data centers in Alberta. Again, this is all part, if you're in favor of non-carbon emitting power sources, then nuclear has to be one of them. And it's been one of the things that the federal government has been majoring on. But there's comments by the Prime Minister of BC, David Eby, saying it's a vampire, it risks becoming a vampire project. We need real projects. Well, this is a real project. I'm certain that they must have done a fair amount of preliminary work in terms of working with Indigenous groups and planning the route. And it is basically very, very encouraging to see that there finally is some movement on this, although, as always, with infrastructure projects in Canada, the proof of the pudding is how long it actually takes to get shovels in the ground to get stuff moving.
And let's start with that part there. Do you think this will happen fairly quickly, or is this going to get bogged down?
Well, this is the major aspect of the agreement that was announced. It's that the federal government is going to actually accelerate permitting, remove a lot of the regulatory obstacles that have stopped major projects getting started. In essence, it's saying, and indeed this has been happening in Ontario as well with the whole Ring of Fire situation, it's to say it is enormously difficult to build anything in terms of the regulatory burden that has grown up, particularly in the last 10 years of Liberal government. If the Liberal government, under its new leadership, is now saying we're going to get rid, not necessarily get rid of, but simplify and remove a lot of that to ensure stuff can get built in a much more timely fashion, then it's obviously good news.
And from the private sector, there's been concern that there isn't enough demand for this. Do you think this will draw private company involvement in, and that's what they're pushing, that this is all going to be built with private companies? Do you think this will draw them in?
Sorry, Roger, I didn't mean to interrupt. I'm sure it will, because now you've got the feds on side. Previously, the whole Trans Mountain expansion, which the federal government ended up having to actually take over because the regulatory environment was so difficult, and has ended up being an enormous success, by the way, tripling the capacity and helping a lot more of Canada's energy exports to go to Asia as opposed to the US. And again, one of the plans, I believe, is to actually increase the capacity on the Trans Mountain again. But it's obviously good news, and it's the private sector is going to say, now we actually, not quite the feds have our back, but that the federal government is a lot more positively inclined towards major energy infrastructure projects. And that in turn will obviously be encouraging for private players to want to come in. And David Eby saying, oh, there's no private involvement. Well, until you knew there was going to be this deal, why on earth would you, given the track record of what's happened in the past decade or so? Now you go, that looks much more attractive.
And with the nuclear, Ontario has been one of the leading provinces when it comes to nuclear. Can you see them being involved with this and maybe restoring Canada's glory when it comes to nuclear power? We were a leader at one point.
Indeed, it's that can-do mentality. Sorry for that.
That's for the older people in the crowd, I think.
Yeah, that doesn't include you, of course. Right?
Of course.
No, again, we did have leadership, and again, we actually have existing nuclear power plants, which is where the small modular reactors, which is what everybody seems to feel is the way forward, because in essence, you can actually build it for a tenth of the price of the really big ones, and you can replicate it, and you can get the repeatable skills. And by the way, you have a nuclear power plant already, so you can the permitting should not be an issue if you put more small modular reactors in, which I think is happening at Darlington in Ontario. So obviously you need to get the environmental permitting if you're going to build stuff in Alberta, but given the Alberta government's attitude towards that, and the fact that the federal government now is in favour of nuclear as a non-carbon emitting baseload source of power. And as you say, Roger, we used to have a very strong position, we as Canada, in this. Why not back to the glory days? Okay,
we're going to leave it at that, Gavin. Thanks. Stick around. We got lots more to talk about, but we'll take a look at the markets before the bell right now. All right, let's take a look and see how things are shaping up on the markets right now. It is interesting, of course. Those are the U.S. futures from a few hours ago, still frozen because of all those issues in Chicago. The Chicago Mercantile Exchange, their data center has some cooling issues, and that has sent everything into a tizzy, and it is affecting pretty much everyone. Asian markets, a similar note right now. They're still trading, but they are slowed down. You can see the Nikkei is up, and the Hang Seng off by 0.34, CSI 300 up by 1/4. European markets, same situation. Certain things are being affected by trading's a little slower. Everybody in the green there, though. And let's take a look at the TSX. Another up day for it, barely, but it was still an up day, record high, fifth day of increases for the TSX. But again, the futures there are being hit by this CME issue. Biggest winners and losers on the TSX from yesterday from a percentage standpoint. Quiet day. Go Easy up by nearly 3%. MBA Space up by 2.6. Toromont down 1.46. Allied Properties off by more than 2.5. And again, futures being affected right now, but you can see gold looks like it's going to close the month up, and silver is as well after that volatile October. Gold's up 6% for the month, silver about 13%. Copper down slightly for the month, but still up 25% for the year. And looking at oil, a bit of a rally, but they are slumping right now. That was Wednesday because they had some issues for Western Canadians. Select crude, though, still down for the month over supply concerns, putting pressure on it. Let's take a look at what WTI is doing. It's also being affected by the CME, and it's still below that $60 mark, but over 59, so that's some good news. And let's bring Gavin back in. Gavin Graham, Chief Investment Officer at Spire Wealth Management, to talk about what's unfolding with the Chicago Mercantile Exchange. We don't really talk about it, I guess, until something goes wrong. This is causing some headaches.
Absolutely. And again, it's just a reminder of the importance of the plumbing behind financial markets. We assume it's all going to work. Well, the volumes have exploded enormously in the last few decades. The quantity of markets you can trade, the amount of financial instruments that you can trade, but it's all dependent on the power actually being on. And especially with all of the data centers that are going to be built for the AI revolution, we've already talked, I think, several times about how much additional electricity you're going to need, how you need to upgrade the grid system. As you were saying, it seems to be issues with the cooling systems for the data centers because they all generate enormous quantities of heat. One of the things that is slightly perplexing is why you're building them in places like Texas or Arizona, where it's really, really hot, as opposed to maybe somewhere a little cooler. But the fact is that this is a reminder of how vulnerable the system is, and that we're going to need to spend a lot of money, quite frankly, just to keep the lights on, let alone actually increase the amount of power provided for things like the electrification of the automobile system. I know and then of course the data center and the numbers out there, Roger. You've probably seen them. You're talking triple, quadruple, electricity demand. 10 years from now, where is the infrastructure going to come from to actually build out this?
And so people need to be looking at those things. I just want to ask, what's it been like for the European markets relative to this disruption? Thankfully, they don't happen that often. I think the fact we're talking about it, they don't happen that often. What's the impact been, though, where you are?
It's slowed things down a bit. Although, again, it's the end of the week, which also tends to be somewhat slower. Here in the UK, we had the budget on Wednesday, which had something like 88 separate measures. So there's lots of people going away and trying to figure out what's happening, which in turn has maybe slowed down volumes a little bit. So it hasn't really had a great effect, maybe a slight slowing down.
And of the markets there, but also we were looking in Asia was doing the same thing. Are people managing to work around it? Are they finding workarounds, or are there any workarounds to it?
There are, but there are, I believe, some contracts that aren't being traded at all. And obviously, if you are the CME or any other exchange, you would prioritize your biggest contracts because those are the ones which, quite frankly, make you the most money and are going to annoy the most people if they're not working. Some of the smaller ones, maybe you can say, sorry, we'll actually get around to that in a few hours. And as always, you're trying to do this while flying the plane, as it were. It's not the easiest thing to do. But that's, again, one potential business area you might look at is business recovery. The companies that have the engineers and have the expertise and have the machinery, maybe there's some portable cooling units being moved in. Maybe that might be worth looking at in future, because if this becomes more common.
Yeah, you would think there would be some built-in redundancies already. So it'll be interesting to see what happens, how it unfolds.
Yeah.
Sorry, go ahead, Gavin.
No, I was going to say, absolutely. You would hope there would be built-in redundancy. One of the absolutely unbreakable rules about introducing new systems is you do not switch off the old system until you're certain the new system is up and running and doesn't have any bugs, although occasionally people do seem to do that. But again, our vulnerability in this interconnected world, the dependence on power sources and reliable baseload power sources, and the fact that stuff happens, especially as the world gets more and more complicated, means that all of this, we need to build in additional redundancy almost certainly, which is going to increase the cost of things, which is going to increase the cost of the raw materials that go into those things and the wages of the people who install them, and maybe that feeds through into inflation as well.
So are there, but on the other side, we're looking at those expenses, but are there opportunities here with what this showed?
Oh, absolutely. As I said, maybe the emergency response, companies that provide that additional capacity, but also, again, some of the same themes with the whole AI and electrification boom. You're looking at utilities, which, my gosh, are back as growth stocks, because you've actually got the demand for your power not growing at GDP plus 1 or 2%. You got it growing at double, triple it because of all these data centers. You want the people who build this stuff out, and particularly you want the providers of the raw materials which are used to build the infrastructure. Things like copper and nickel and aluminum and steel and cobalt and all the other stuff. So those are all things which have been themes that have worked for a while and are likely to continue to do so.
Okay, we're going to leave it there. Gavin, in one note, the Chicago Mercantile says it's going to be back up and running 7:30 Central Time. So we'll be talking a little more coming up after the break. Stick around, Gavin. Young Canadians are richer than ever, but their paychecks aren't keeping up. We'll break down what's driving the disconnect after the break. A new report from RBC shows that young Canadians have built wealth faster than any other age group since 2020, but their income growth tells a very different story. To help break this down for us, we're joined by Rachel Battaglia, economist at the Royal Bank of Canada. Rachel, thank you very much for joining us.
Thanks for having me.
It's surprising to hear that young Canadians are socking money away. We've talked about how they're struggling, but yet they're finding ways to make some money right now. How's that working?
Well, we've been looking a lot at the health of the Canadian consumer, in part because this has been one of the strongholds for the Canadian economy amid all of this trade turbulence. But you're right, it begs the question of, is this being felt uniformly? And if we look at young Canadians in particular, those households where the primary income earner is under 35, we are seeing some signs of struggling. If we look at incomes in particular since the first quarter of 2020, we'll see that incomes have fallen behind the national average. And if we seasonally adjust that data on a real basis, we'll see that those incomes have actually fallen below the rate of inflation as well, which suggests that on a real basis, incomes are declining for that group. Now, that's a pretty stark contrast from what we're seeing on the wealth side, which is wealth accumulation has grown faster for that group than any other age cohort. Again, that's since the first quarter of 2020 until the second quarter of 2025.
Gavin, you have a question for Rachel.
Yes, Rachel. So people have been talking about the K-shaped recovery, where those people who have assets and have benefited from the stock markets going up are doing pretty well. But those people who are actually living paycheck to paycheck, and obviously the majority of those would probably be under 35 because they're just starting out, they haven't had a chance to accumulate, are not doing so well. This research would seem to support that, I imagine.
Well, it does in part. Incomes and wealth measure fundamentally different things, right? Incomes measure more so a flow of money, whereas wealth is more so looking at that stock. And to build wealth, you generally need to convert that flow of money into assets. Now, that's a process that can be very easily disrupted by increased spending, be it on taxes or due to inflation or just other spending pressures. And it can also be disrupted by slower growing income gains. Now, for younger households, this is exactly what we're seeing, right? On a real basis, those income gains are failing to keep pace with inflation. However, we have to remember that we've seen pretty impressive home price appreciation over the last 4 years or so. Home prices have come down recently. However, they're still sitting about 25% above where they were at the end of 2019 and beginning of 2020. We've also seen really impressive equity market performance and pretty high levels of government transfers, particularly during the pandemic when we saw that CERB-style disbursement. Now, those are things that disproportionately benefited the net wealth position of those younger households, given on average they tend to hold on to lower reserves. In addition to that, I will also point out that we've seen a pretty juicy uptick in the financial asset holdings of those groups. Now, that includes things like cash deposits, which brings into question the role that intergenerational wealth transfers are playing in all this as well. Because if we look at income statistics and we look at the labor market, we're just not seeing that compensation growth is really supporting that.
So is that what we're starting to see? Is it inheritance and parents sending them money? And where's most of their wealth coming from? Is it coming from the market, or is it from the markets, or is it coming from buying a home and watching their home appreciate?
Well, a little bit of both. Financial assets is a big cause for that uptick, but so is net real estate holdings. On the liability side, which is equally as important too, I'll point out, we've seen younger households cut their mortgage exposure too faster than other age groups. That could be for a couple of reasons. One being that younger households who originated or renewed a mortgage during those ultra low interest rate period of 2020 and 2021, they benefited from those low borrowing costs and were able to pay down that debt faster. At the same time, though, since about 2022, I'll say, we've seen more younger Canadians postpone or avoid home ownership altogether. And that also impacts the liability side of things as well.
All right, we're almost out of time, but Gavin, we'll give you the last question.
So would it be fair to say then, Rachel, that the under 35s are doing okay generally, but there are some cause for concern with the income falling behind the rate of inflation?
Well, it's the sustainability that is where we are most concerned. This is not a very good foundation for them to continue accumulating wealth or to even maintain the wealth that they have built recently. Without incomes, you're relying more heavily on factors that are further from your control. Things like market timing or government transfers or the ability or willingness of family members to transfer that wealth over to you.
Okay, we're going to have to wrap it up there, but Rachel, thank you very much for joining us today.
Thanks for having me.
Rachel Battaglia is an economist at the Royal Bank of Canada. Still ahead, this year's third quarter GDP is being released this morning. We'll talk about that with our next guest, and our phone lines will open soon for our first call segment, 1-855-326-6266, or send us an email at firstcall@bellmedia.ca. Identity and Culture Minister Stephen Guilbeault has resigned from cabinet over Prime Minister Mark Carney's energy deal with Alberta, specifically the pipeline agreement. Guilbeault says Carney failed to consult Indigenous communities and the pipeline would pose significant environmental risks. Guilbeault served as both Heritage and Environment Minister under former Prime Minister Justin Trudeau. He will remain in Parliament. Alberta is lifting its 2025 gross domestic product forecast. The province now expects GDP to rise by 2.1% this year, while 2026 growth is expected to moderate further to 1.8%. Alberta's budget update also signals lower borrowing needs compared to the first quarter. The province's deficit is expected to be $6.4 billion for 25-26 fiscal year. The Chicago Mercantile Exchange has partially restored operations after an outage that halted trading of futures and options. CME says its major global futures markets are still down, but its Globex futures and options markets will open at 8:30 a.m. Eastern Time. The exchange operator has given no details about when other affected platforms will resume operations. The outage was caused by a cooling system malfunction at a data center. And so that, of course, is affecting the futures, but it looks like we're starting to see some of them right now. They're moving again. All on the green, all slightly up. NASDAQ 100 leading me up by a quarter right now, so things are starting to return to normal. Stats Canada has just released Canada's third quarter GDP numbers. Real gross domestic product increased 0.6% in the third quarter of 2025 after falling 0.5% in the second. The rise in the third quarter was driven by a strengthening trade balance as imports dropped and exports edged up. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay.
Have avoided a recession. This is kind of in line with what a lot of economists that were polled by Bloomberg expected. So as you mentioned, within the third quarter, GDP grew by 0.6%. A Bloomberg poll of analysts had predicted an annualized growth rate of 0.5%, so just a little above that. When it comes to the month of September, month over month, we saw an increase of 0.2%. That's compared to 0.2 in real GDP that was predicted by economists, so right on line there. And then year over year for the month of September, up by a full percentage point, and that's compared to a 0.6% prediction by analysts. So these numbers might not sound like a lot, but it does represent kind of a pivotal point for Canada when it comes to our economy, especially after we saw a decline in the second quarter, a decline for the GDP. And so if we'd seen another decline in the third quarter, we would technically be in a recession. So a bit of good news today. And we know Statistics Canada have been doing polls beforehand and said an increase in finance and insurance, mining and quarrying, and oil and gas extraction in September. That was partially offset by a decrease in wholesale trade and retail. So that's where we're seeing those numbers for month over month and year over year. And then, of course, this comes just ahead of the Bank of Canada's last scheduled interest rate decision of the year. That's expected to happen on December 10th, which is about a week and a half away, if you can believe it or not. So we'll have to wait and see exactly how these numbers maybe impact that decision. Most economists that were polled still think we're in a kind of wait and see position for December.
Okay. Lindsay, thank you for that update. BNN Bloomberg's Lindsay Biscay. And for more on the GDP, let's unpack those numbers with our next guest, Jimmy Jean, Chief Economist and Strategist at Desjardins. Jimmy, thanks as always for joining us.
Good to be here.
Were the numbers where you expected?
The numbers obviously came in much above expectations. However, looking into the details, we find lots of surprises. You see, and it's actually the mirror opposite of what we saw in the second quarter. In the second quarter, the weakness was largely due to net trade, so the collapse we saw in exports. Now, in this time, we see that upward surprise, but it's due to, again, that net trade component, and particularly, it's not a story about exports recovering. It's really about imports collapsing. And that mechanically produces that strong increase in GDP. But when you look at domestic demand, which had been the very positive story in Q2, we're seeing a decline of 0.1%, and you're seeing cutbacks in consumer spending in particular. So I think that's cause for concern here.
Okay, Gavin, we'll let you jump in here.
So although we've officially avoided a recession in the sense of 2 negative quarters, as you said, from the details, it looks as though firstly, it's largely mechanical because of the trade balance improving, not because of exports growing, but imports collapsing. And secondly, that seems to be reflected in lower domestic demand. That's not a particularly optimistic outlook, is it?
It's well, I'm concerned about what we saw, particularly knowing the dynamics we're seeing in the labor market. We had an indicator yesterday coming from the survey of employment payrolls and hours, and earnings payrolls and hours. And what this told us was that in September we saw 58,000 decline in employment, and that was completely opposite to the signal we earlier had from the other survey, the labor force survey. So in this survey, we tend to put more weight on that one particular survey that came out yesterday because it's actually a census of businesses as opposed to just being a survey of households. So this is something that's very important. The second thing I think that we should be looking at very closely is what happened in the flash estimates for monthly GDP numbers. So we received that as well today, and what we learned is that in October GDP seems to have contracted 0.3%. So there's a lot of choppiness in the numbers, but a 0.3% negative at the onset of a quarter really suggests that quarter will probably see weak growth. The Bank of Canada was hoping for 1%, but we've been tracking below that, and that tracking might be reduced further.
And I just want to jump in on a couple of things here. The investment in residential structures was up by 6.7%. Also, government investment expenditures, another major contributor. What Where did those two numbers come from? Let's start with the residential structures. An increase like that.
Well, I think what we've seen this year, and that's actually one of the good stories that has been sustained in this report, is that we've seen stronger construction, residential construction, and that's been boosted by various federal policies, but also provincial policies that have been put in place over recent quarters. So we're seeing the effect of that. We're seeing the effect of as well monetary policy accommodation. Residential, the real estate market tends to be the first one to respond to that. And in addition, we've seen strong sales. Sales have recovered in Ontario, and we've seen also strength in Quebec on that front. And that will be captured in those GDP numbers when sales activity, when the number of transactions improves. So I think it's a reflection of that. So it means not all hope is lost when it comes to domestic demand, but you are definitely seeing households being more prudent. You see that in how the saving rate increased, and as well as that contraction in consumption spending. So I think it's not the residential part is not something we can take for granted either. You have some pockets of the market that are oversupplied. You have that deceleration in population growth that is going to hurt demand in that space. So, to your point about the government, I think much of growth in 2026 will rely on government spending and progressively government investment.
Not always a good thing. We'll leave last question to you, Gavin.
So would it be fair then to think that perhaps the Bank of Canada, looking at these rather weaker numbers, might decide to cut again when they meet in early December, especially as it looks likely that the Fed is now leaning towards cutting interest rates as well?
I think for now they will be on hold, but still, I think they will take note of that information in the sense that the domestic demand came in weaker, and also that new information coming out of the labor market. They've signaled in the past that the labor market would be a key factor they'd be looking into. I think at this point they just want to get more data, more confirmation. Like I said, there's in some sense there's a lot of choppiness. So they want to have a clearer signal. So, if I have to guess for December, I think they're still on the sidelines. But they've been clear as well that if the numbers, if their tracking was to be disappointed, if the numbers were to surprise to the downside, they'd be ready to move again. So that's certainly still an open possibility for 2026, I would say.
Okay, we're going to have to wrap it up there. Jimmy, thanks as always for joining us.
Pleasure. Thank you.
Jimmy Jean is chief economist and strategist at Desjardins. Up next, we'll be back with Gavin Graham to see what's on his radar. And of course, our phone lines are open. Gavin will be taking your questions on stocks. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Time to see what's on Gavin's radar. We are back with Gavin Graham, Chief Investment Officer at Spire Wealth Management. And Gavin, let's start first with First Quantum and First Quantum Minerals, I should say. And why is it on your radar right now?
Indeed. Well, talking about the demand for copper growing because of all these data centers for the AI revolution and the electrification of the auto industry. First Quantum is a major copper producer, about 400,000 tons a year. Its major factor was that the very big mine they had in Panama, the Cobre Panama mine, got shut down a couple of years ago by the Panamanian government, which is a little surprising because it's sort of 5% of GDP and employs 40,000 people. The new government that's come in last year is actually in negotiations with First Quantum. So you get an option effectively on that reopening, which would add several 100,000 tons. But even without that, its operations in Zambia are doing really well. They've opened an extension of their Kanchansi mine, and they also have reduced their debt by doing a $1 billion gold royalty on the gold production from Kanchansi, which makes their financial position look pretty good. So you're up quite a lot this year, I think about 55, 60%, although still below where you were before Cobre Panama got closed down. But again, if you're looking for beneficiaries of the various long-term trends we've been talking about, copper miners are there. You've seen Anglo American taking out Teck, and you saw BHP trying to take over Anglo again for the second time in a year. The people in the mining industry think that getting exposure to copper in politically stable countries with a good record of working with mining companies is a pretty good idea.
Okay, let's move on to Cap REIT. What do you like about that?
Well, the biggest apartment REIT in Canada, we were talking about how people maybe weren't buying, younger people weren't buying apartments or homes because they got expensive. Interestingly, the growth in the average monthly rental has kept pace with the growth in earnings. So it doesn't cost you any more as a percentage of your income to rent somewhere. And Cap REIT, firstly, has simplified its portfolio. Effectively, it's got rid of almost all of its European exposure in Belgium and the Netherlands and Germany, which is about 15,000 apartments. It's upgrading its Canadian portfolio. Oh, by the way, it sells at about a 30% discount to its NAV, which, given that you get a best part of a 4% yield that's growing gradually, and that whenever it's been at this level of discount, you've generally seen that discount narrow. If rates are to come down further, this looks to be a very obvious play on the continued demand for affordable accommodation in Canada.
Okay, and we want to get the last one in here, Canadian Natural Resources, CNQT.
Well, here we are, one of the largest oil and gas producers. Murray Edwards has been running it for years and running it very successfully. One of the lowest cost producers, I think their oil sands, it's about $21 a barrel. You've seen the discount between Western Canadian oil price and West Texas narrow because you got the extension of the expansion of the Trans Mountain. If we now get the new pipeline to the West Coast that Mr. Carney and Ms. Smith were talking about, that's obviously good news for someone like CNQ. In the meantime, they've raised their dividend for 25 years in a row. You're getting a pretty reasonable 4 or 4.5% yield. And there's a possibility that they might make more acquisitions because they bought, for example, Chevron's 20% stake in the oil sands operations last year. And Tourmaline has got a big portfolio that's up for sale, which might be something that they'd look to add.
Okay, we're going to take a break on that note, but Gavin's going to stick around and give us some reaction to some of the notable analyst calls and recommendations from this morning. Stay with us. And let's take a look at some of the notable analyst calls and recommendations for the day. Desjardins has a few initiations on gold companies this morning, starting coverage of OceanaGold Corp with a recommendation of buy, and a PT set to $50 implies a 43% increase from last price. Kinross Gold is initiated with a recommendation of buy with PT set to $44, a 15% increase from last price. And Alamos Gold also with a recommendation of buy and a PT set to 64, implying a 24% increase from the last price. Let's bring in our guest co-host for more on this. It's Gavin Graham, the Chief Investment Officer at Spire Wealth Management. Gavin, thanks for joining us. Which one would you like to chat about first? Shall we start with OceanaGold?
I'm not sufficiently familiar to talk in detail about that, but Kinross obviously has been a very major player. It's got a very widely diversified geographic portfolio. One of the issues, I think, with mining in general, which we touched on briefly before the break, is the political environment in which you're operating, because you can't move a mine. So therefore, as we've seen with some of the major players like Barrick, where their operations in Mali were effectively taken over by the government and some of their executives held in prison for the best part of a year until they actually agreed to pay more money. You need to be somewhat careful about the jurisdictions in which you operate, which is why we tend to prefer those in politically stable jurisdictions with long life reserves, which mostly means North America and Australasia. But Kinross has managed its portfolio very well. It's obviously done extremely well in terms of the stock price performance, as indeed virtually all the gold companies have, with the interesting exceptions of the two biggest, Newmont and Barrick, where management issues and the difficulty of growing your production once you got up to the sort of 4 million ounce a year level, they haven't really moved at all, even though gold itself had doubled over the last 5 years until the last few months. And actually, we've seen changes of management at both of those major companies. But Kinross has done really well. Alamos is one we really like because it made a very accretive acquisition last year. Literally, the mine was over they bought was over the other side of the lake that they themselves were operating in. So this is probably the fastest growing medium-sized gold company in Canada, and that is well reflected in its share price. The management has an excellent track record of operating the business, so we like it a lot.
Okay, just one quick question. When you talk about more of the safe, reliable countries, North America, Australia, what are some of the other ones that people might not think of that you look at?
Well, South Africa obviously used to be the major player, and it still has some very well-established gold companies. There are one or two European countries, like, for example, Spain, but in general, and actually one of Agnico Eagle, which is now, would you believe, the biggest gold company by market capitalization, having overtaken Barrick and Newmont, actually has a major Finnish gold mine. So there are areas where you might not think, but which have a stable political background and gold reserves.
Okay, we'll leave it at that note there. And when we come back, Evan's going to take your questions on First Call. All right, time for First Call and first email, and it goes to Carl, and he asks, may I have your opinion on Northland Power for a buy? They had a dividend cut, and the stock had a good setback. Gavin.
Yes, well, this is one that I've actually written up, and obviously disappointing. They cut the dividend, and there you can see the big sell-off. But you'll note that only takes it back to where it was about a year ago, because it had been doing quite well. It had already halved from the peak of the enthusiasm for wind power companies, because, of course, it's got some very big wind power assets in the German North Sea. The major reason for the dividend cut was they're building two very big projects, one in Poland, offshore Poland in the Baltic, and one offshore Taiwan. And the Taiwan project, I think it's Hailong, is going to take a bit longer than they thought, so they won't get as much cash. They have actually just started a 250 megawatt battery storage facility at Oneida in Ontario, so that's going to contribute quite a lot. But as always with these large projects, if you get any slippage in timing or in cost, it can affect the numbers, and the new management felt that it was more responsible to actually take a 40% cut in the payout. But if you believe the longer term future in terms of these major wind power operators, Northland is now relatively cheap, and the dividend is sustainable going forward. And when they do bring those two projects on, it may actually recover somewhat.
Okay, let's move on and get this email in from Mike. I'd be interested to hear your guest take on Capstone Copper. Well, I think we know what you think about copper, Gavin.
Yeah, absolutely. And again, copper companies in general, there's not a lot of it about. It takes 5 to 10 years, if you're lucky, to get a new mine into operation. So if you have some and you're producing, you're doing really well. And as you mentioned, Roger, I think earlier in the program, copper itself is up 25% this year, from $4 a pound to $5 a pound. And quite frankly, it's difficult to see it going anywhere but up in the longer term. Having said that, the old joke about copper is it's the only metal with a PhD in economics, because it's so economically sensitive, because it goes into so many different industries. And if we do get a bit of a slowdown and a recession, you might see a temporary pullback. But in the meantime, as you see, you're doing pretty well with Capstone.
Okay, sorry, I've never heard that one before.
Oh, really? Okay, yeah. It's literally virtually every product in the modern world uses copper, so it is very, very economically sensitive, and therefore, look at what Dr. Copper's saying.
Okay, all right. Let's get this email in, and it's from Al, and it says Al is asking, what do you think of Samsung?
Well, as the largest Korean semiconductor producer, obviously it's got a very, very strong position. Interestingly, they're building plants in the US partially to attempt to avoid uncertainties from the change in tariff policies by the US administration. But obviously it's a major, major player in that space. It's the largest company in Korea, if my memory serves me correctly, and it's a major longer-term play on what's happening in the world of chips, but also consumer electronics as well. So if you like that, then this is not a bad one to have. Okay, and just before we go, Gavin, we're going to take a look. Apparently the U.S. futures are now moving again. Let's just see what they're looking like right now. I don't know if you can. I hope you can see this. They're up. Is there going to be any kind of catch-up right now, or is this we're all going to put it behind us and look ahead to the markets opening? probably put it behind. But remember, of course, Roger, this is Black Friday. It's the day after Thanksgiving. Half the people in the US are still sitting on their couches with an overdose of turkey. So, it's not a particularly busy day, and maybe, lower volumes. But I would say that in terms of the actual longer-term effect, all of these previous outages have had no permanent effect. It's just a short-term inconvenience. And as noted, a reminder that we are quite vulnerable to disruptions.
Could we see any lawsuits coming out of this, do you think?
I'm sure there'll be lawsuits because it's the States, but whether or not they're actually able to, win anything from it is another matter.
Okay, but for now, it's just going to be back to business as normal. And just one last, we're almost out of time, but what do you think we're looking at for December?
In terms of market performance?
Yeah.
I think, it's Santa Claus rally. We've had a pretty strong market already. I know we're up 15, 20%. Although, interestingly, you'll note the non-US markets in Europe and even the good old TSX is doing better than the S&P by quite a margin, even before you take in the fact that US dollar's going down. But we're likely to see a continuation because as it goes the first 11 months, usually it goes for the 12th month as well.
Okay, and we're going to leave it there. Gavin, thank you as always for joining us.
A pleasure as always, Roger.
Gavin Graham is Chief Investment Officer at Spire Wealth Management. And he's up next with the Open. The markets will open normally in about 30 minutes from now. Have a great day.